Welcome back to the deep dive. Today, we are wrangling a massive stack of sources that really reset how we should be thinking about global financial stability, institutional independence, and corporate strategy.
That's right. And this isn't just a collection of disparate headlines.
No, not at all. It's a really detailed look at the extreme costs being imposed on global players right now. We're talking massive, multi-billion-dollar capital battles, these unprecedented corporate infrastructure bets.
Bets that completely redefine energy consumption.
Exactly. And on top of that, these fierce political contests over who actually controls financial power.
So our mission today is really to give you a shortcut to understanding what's at stake here. We need to, quickly extract the most critical insights from all this.
From Swiss banking to U.S. monetary policy.
All the way to the new face of corporate energy. It's a deep dive into some very high-stakes, contentious global decisions, and we're going to show you why these non-market factors are, well, they're defining the economic future.
Okay, let's unpack this. Let's start right in the deep end with finance and the regulatory squeeze that's being applied to global capital. We have two major battles playing out.
Right. One involves UBS, the largest Swiss bank, and the other affects millions of U.S. consumers and their access to credit.
So let's start with UBS. What's happening there?
Well, the situation with UBS and the Swiss regulators, it really highlights a global tendency toward extreme caution after a crisis.
You mean post-Credit Suisse?
Exactly.
Okay.
Following the Credit Suisse collapse, the Swiss Federal Council is pushing this core proposal that would just radically restructure how UBS holds capital. Specifically, they want the full deduction of foreign subsidiaries from the bank's highest quality capital.
Their CET1 capital.
Their Common Equity Tier 1, or CET1, correct.
Okay, hold on. Let's quickly define that for everyone listening. What exactly is CET1, and why is deducting foreign subsidiaries from it so contentious?
So CET1 is basically the absolute safest, highest quality capital a bank holds. Think of it as equity and retained earnings. It's the buffer that's designed to absorb losses before, taxpayers or the financial system get threatened.
And there are already international rules for this, like Basel III.
Of course. But this new Swiss proposal, it goes way further. It mandates the full deduction of foreign losses from the parent company's CET1. The goal is to completely insulate the Swiss parent bank from any failure anywhere in the world.
And UBS, I'm guessing, sees this as completely disproportionate.
Oh, completely. They argue it would force them to hold dramatically more capital than their European or U.S. competitors. The proposal is based on what the source material itself calls an extreme assumption.
Which is what?
The assumption that the parent bank have to be able to absorb the total 100% loss of all its foreign subsidiaries at the same time. Yeah. I mean, traditional regulation assumes maybe a partial or tiered failure. But the memory of Credit Suisse is clearly driving them to this maximum security approach. They feel that the old concessions undermined resilience when the stress finally hit.
That desire to avoid a repeat is understandable, but that extreme assumption must come with an extreme price tag, right?
It absolutely does. The proposal would require something like $23 billion in additional CET1 capital immediately.
Mm-hmm.
And when you factor in all the adjustments from the Credit Suisse acquisition, the total hits a staggering $39 billion.
$39 billion.
And UBS estimates that burden will cost them around $1.7 billion a year just to maintain that new ratio.
So if the government wants stability, they get it. But what's the friction? What happens when you force a global bank to be, 50% better capitalized than its rivals?
Well, UBS argues those costs have to be passed on somewhere. And that means price increases for loans and services inside Switzerland, which could weaken their own domestic economy.
But the bigger issue is the competitive distortion, isn't it?
That's the major issue. This framework actually favors foreign banks, especially from the EU, that can operate in Switzerland with much easier capital requirements. It basically encourages Swiss clients to go get capital from foreign, less regulated banks.
So it pushes the risk out of the Swiss system, but not out of the Swiss market. You're creating a regulatory arbitrage opportunity.
Exactly. It's a fundamental dilemma in post-crisis regulation. The hunt for ultimate stability risks isolating your country and distorting the local competition.
All right, let's shift continents now. Let's focus on U.S. consumers and a very different kind of regulatory pressure. This bipartisan Senate proposal to cap credit card interest rates at 10%.
Right, and this is a classic case of good intentions meeting, economic reality. The idea is to curb excessive interest, but the analysis in our sources projects the cap would massively restrict access to regulated credit.
For how many people?
Using 2019 data, the cap would adversely affect at least 14 million U.S. households. These are the households that rely on credit cards and, rarely pay their balances in full.
14 million is a huge number. But I can hear the supporters arguing that those 14 million people are being crushed by interest rates near 30%. Why is cutting off their access to those cards a bad thing? Why shouldn't usury laws exist to protect them?
The core counter-argument from the sources is that for many of these high-risk borrowers, that high interest rate is what makes the loan possible. It's necessary to offset the probability of default.
The bank's core loss.
Exactly. So if you get rid of the reward, the interest rate, you get rid of the incentive to take on the risk, and the data is stark. Nearly 3/4, 73.2% of identifiably high-risk consumers would either be cut off from credit entirely or see their credit lines massively reduced.
The market math is pretty undeniable then. If the interest incurred doesn't cover the risk of default and the cost of the account, the bank just won't make the loan.
Correct. And the so what for those borrowers is critical. Reduced access stops them from doing the hard work of rebuilding their credit. And crucially, it pushes them toward costlier and less regulated alternatives.
You mean payday lenders, title loan shops?
Things like that, where the effective annual interest rate is far, far higher than any credit card. For millions, card credit, even with high interest, is a vital source of backup liquidity for an emergency. The paradox is that trying to reduce the cost of credit could end up eliminating access to regulated credit for the people who need it most.
So in both Switzerland and the U.S., we're seeing regulators make these moves that risk financial inclusion or stability, all driven by the shadow of past crises. It's a posture of extreme costly caution.
That's the pattern, absolutely.
So if governments are willing to impose these huge, sometimes isolating costs on their banks for stability, what happens when political actors start imposing costs on the very institutions designed to ensure the stability of the entire economy?
Now we're moving from regulatory costs to political coercion.
Let's transition to the political sphere, because this next development it's an immediate and frankly shocking threat to the independence of the U.S. Central Bank, the Federal Reserve.
Right. The sources report that the Department of Justice served grand jury subpoenas to the Fed regarding Chair Jerome Powell's testimony from last summer.
And this was about renovations to the Fed's headquarters. It involves potential criminal charges.
It does. And this is completely unprecedented. Powell's response was equally unusual. He didn't just issue some quiet written statement. He went public with a video framing the threat of criminal charges as an unprecedented action that has to be seen in the context of the administration's threats and ongoing pressure.
He was incredibly direct about the motive, wasn't he?
Unequivocal. He dismissed the whole renovation thing as nothing more than a pretext. He stated clearly that this threat is a consequence of the Fed setting interest rates based on economic data rather than following the preferences of the president.
So the implication is that the DOJ is being used to intimidate the Fed into changing monetary policy?
That is the clear implication.
And the political reaction to this was immediate and strong, and it crossed party lines in a way you just don't see anymore. The severity of this threat clearly registered in Washington.
Oh, absolutely. Look at the Republican response. Senator Tom Tillis pledged to block all future Fed nominees, including the next chair, until this is resolved. He's openly questioning the DOJ's credibility.
And he wasn't alone. Senator Murkowski, another Republican, said if the DOJ thinks this is warranted, then Congress needs to investigate the DOJ itself, calling it nothing more than an attempt at coercion.
And this wasn't just a Republican concern. Democratic Senator Elizabeth Warren, who is often a very harsh critic of the Fed, she came out forcefully, denouncing the move, saying the president is abusing the authorities of the Department of Justice like a wannabe dictator.
That bipartisan condemnation says everything about the perceived threat here. There's a shared understanding that the Fed has to be insulated from short-term politics for the long-term health of the economy.
And to really get the severity, you have to look at the historical context. Former Fed chairs Yellen, Bernanke, and Ellen Greenspan, they issued a joint statement.
What did they say?
They said this type of action is how monetary policy is made in emerging markets with weak institutions.
That comparison, equating the U.S. to emerging markets, that's the highest possible warning shot. What are the specific implications if that institutional trust is lost?
It creates systemic risk.
Yeah.
I mean, it undermines the entire framework of the global dollar system. The dollar is the world's reserve currency because the market trusts the Fed to act rationally and independently.
To prioritize long-term stability over short-term politics.
Exactly. If that independence is compromised, the market starts to factor in a political risk premium. And for you, that means higher inflation expectations, more volatility, and ultimately a global loss of confidence. It has direct negative consequences for your purchasing power and the stability of the markets you invest in.
So the financial cost of political interference could just dwarf the regulatory costs we were talking about earlier.
It could, and very quickly. This makes the DOJ probe less about project overruns and more about the fundamental structural integrity of the entire U.S. economic system. The friction is political, but the consequences are entirely economic.
Okay, let's pivot now from political instability to massive corporate strategy. Here, the price tag is measured in tens of billions and the energy consumption in gigawatts. We're looking at Meta's monumental bet on artificial intelligence and how that's forcing them to completely change their business model.
What's really remarkable here is the radical shift in their capital model, all driven by the AI race. Meta plans to more than double its 2025 capital expenditure. We're talking 66 to $72 billion.
That's a $30 billion increase year over year.
A $30 billion increase, specifically for building their massive AI Titan clusters. This isn't just an expense, it's a full-on industrial commitment.
And to power those titans, they are making these, well, almost unthinkable energy commitments. This goes way beyond just buying some solar farms.
Oh, way beyond. They are committing to securing 6.6 gigawatts of nuclear power capacity by 2035.
6.6 gigawatts.
Through deals with companies like Vistra, TerraPower, and Oklo. And to put that number in perspective for you, that is roughly the entire installed generating capacity of a state like Idaho. They are creating a new utility-scale power market just for themselves.
The scale is just immense, and it's concrete. I mean, their Prometheus supercluster in Ohio alone requires 1 gigawatt of compute power. That's a small, modern nuclear plant for one data center.
Right, and a shift like this requires more than just money. It requires political and diplomatic savvy. To manage this build-out, Meta made a key strategic hire, Dina Powell-McCormick.
From Goldman Sachs, with a deep policy background.
Years of expertise at Goldman and in high-level policy positions, including time in the White House.
So why do you need a policy expert to secure energy deals? Why not just hire a utility specialist?
Because the mandate here is explicitly about managing complex financing and forging high-level partnerships with governments and sovereigns to fund this. They need cheap, long-term power agreements, they need huge tracts of land, and they need to navigate permitting processes that can take decades.
So when you build capacity that's equivalent to a small state's grid,
You become a national security and energy policy priority for whatever government you're dealing with. It signals a move away from a capital-light software company to a capital-intensive, partnership-driven industrial powerhouse.
so that's the real shift. They're exploring working with financial partners to co-develop data centers. They're turning their infrastructure into a joint venture asset class.
Exactly. And this puts huge short-term pressure on their cash flow, on their return on invested capital. But the trade-off is clear. They're accepting that financial pressure to secure a foundational, long-term advantage in the AI race. The largest tech company in the world is pivoting its leadership to focus on high politics and sovereign finance.
The very non-market factors we've been talking about this whole deep dive.
Precisely.
Okay, moving from corporate bets to global trade friction, we have two quick but important international regulatory developments. First, a victory for renewable energy in the U.S. courts.
Yeah, the U.S. District Court in Massachusetts struck down the federal freeze on wind energy permits, the wind presidential memorandum, as illegal and arbitrary. And the ruling is national.
And the court cited the government's failure to act within a reasonable time, noting that literally no permits have been issued. So this should really smooth the path for stalled wind energy developers. A win for clarity.
Definitely. And on the international trade side, we saw the European Commission finalize anti-subsidy duties on Chinese battery electric vehicles, or BEVs. The duties are steep, ranging from about 7.8% up to 35.3%.
And this is the EU trying to protect its domestic auto industry from what it sees as state-subsidized competition.
Correct.
So what does this all mean for Chinese exporters? Is this just a hard stop on their access to the European market?
Not necessarily. The EU is looking for a WTO-compatible solution to avoid a full-blown trade war. They've issued a guidance document for Chinese exporters to submit what are called price undertaking offers.
A price undertaking offer. Can you explain what that is?
It's essentially a negotiation. The Chinese exporters commit to adjusting their behavior to address the EU's subsidy concerns, and in return, they avoid the full tariff. These offers have to address things like a minimum import price and, critically, future investments that the Chinese companies might make inside the EU.
So it's an active economic balancing act. The EU is using the threat of tariffs to leverage local investment and fair pricing.
That's the game.
So what does this all mean? We've covered everything from the $23 billion in extra capital on UBS to the political firestorm around the U.S. central bank and this immense $72 billion bet Meta is making on nuclear energy. The common thread here seems to be the high cost and complexity of navigating non-market factors, regulation, and politics all over the world.
That's the big takeaway. Whether it's the capital deduction forced on a bank in Switzerland or Meta needing high-level policy experts just to secure 6.6 gigawatts of power, these external factors are defining the financial and corporate landscape. Managing regulatory risk is now every bit as important as managing market risk.
We've seen a political attack on the U.S. central bank that leaders denounced as the method of emerging markets with weak institutions, while at the same time, the world's largest tech company is pivoting its whole model to navigate high politics just to secure its basic infrastructure.
It really feels like a pivotal moment of institutional stress worldwide.
The world is de-risking in very costly and very contentious ways. And that brings us to our provocative thought for you to take away. If the stability of major financial institutions is now being determined by how aggressively they have to protect against the extreme assumption of total global loss, and if the U.S. economy's primary stabilizer, the Federal Reserve, is facing open political coercion, how should you reevaluate the true risk-free components of the global financial system? Where do you find safety when the institutions designed to provide it are themselves under the highest stress?